You work hard for your money. You're responsible. So you do the responsible thing and keep a nice chunk of cash on the sidelines for safety, for a rainy day, or maybe you're just waiting for the perfect moment to invest. It feels smart, doesn't it? Well, what if I told you that this one single responsible decision is actually the biggest threat to your financial future? It's a mistake that's so dangerous because it happens in complete silence. Your safe cash is being quietly eroded and the magic of compounding has been shut off. The most obvious enemy of your cash is inflation. Think of your cash savings as a bucket of water, but what you don't see is that there's a tiny, slow leak. That leak is inflation. Recent data shows the annual inflation rate is hovering around 3.3%. Now that number might not sound terrifying, but it means your bucket is constantly losing water. That $50,000 you had tucked away 10 years ago felt like a full bucket, right? But after a decade of that slow leak, its real-world purchasing power has been significantly drained. It just doesn't buy you the same amount of groceries, gas, or housing. By doing nothing, your money is actively losing value every single day. But that slow leak is only half the story. The much bigger, more devastating mistake is preventing the single most powerful force in finance from working its magic: compounding growth. Think of investing as packing a small snowball at the top of a very long, snowy hill. When your money is just sitting in cash, that snowball is just sitting in your hands, going nowhere. But when you invest it, you send that snowball rolling down the hill. It starts picking up more snow. Those are your returns. And soon, the new snow it picks up starts picking up its own snow. It's a chain reaction that over time can turn a tiny snowball into an unstoppable avalanche of wealth. Letting cash sit on the sidelines breaks this entire cycle. The snowball never leaves your hands. In the beginning, the damage is almost invisible, which is what makes this mistake so sneaky. But over a few decades, the difference between a snowball that's been rolling uninterrupted and one that never started is the difference between having some savings and having life-changing wealth. So many people hold cash because they're terrified of a market crash. They're waiting on the beach for the perfect wave to arrive before they get in the water. Here's the hard truth. Trying to time the market is like trying to predict the perfect wave. It's a losing game. The secret isn't timing the waves, it's learning how to surf. The best days in the market often show up right next to the worst, and you have to be in the water to catch them. We saw this play out perfectly after the 2008 financial crisis, and again during the March 2020 COVID crash. Investors who panicked, paddled back to shore, and put their money in the safety of cash missed the incredible waves that followed. In fact, one analysis showed that if you miss just the 10 best days in the market over a long period, your total returns could be slashed nearly in half. The secret isn't timing the market, it's time in the market. Consistency will always be trying to predict the future. So what's the answer? It's about turning your idle cash into a productive asset. It's about getting in the water and starting to surf. For most people, one of the simplest and most effective ways to get started is by investing in a broad market index fund, like one that tracks the S&P 500. Think of the market as a powerful ocean current. An index fund is like a sturdy raft that lets you ride that current. Historically, the S&P 500 has delivered an average annual return of about 10% before inflation. Now, that's a long-term average. It's not a guarantee, and some years the water will be choppy, but it proves a powerful point. Over the long haul, that current is an incredible engine for growth that consistently outpaces the slow leak of inflation. Let's just marvel for a second at the power of that rolling snowball. Imagine you add a little more snow to it every single month by investing $1,000. If your snowball were to roll down that hill and grow at that hypothetical 10% average annual return, do you have any idea how big it gets over 40 years? It's not a few $100,000. That consistent habit could grow your snowball into over $5 million. Again, that's not a promise. It's a demonstration of a mathematical principle. Small, consistent actions, when powered by compounding, can lead to extraordinary results. Every month your money sits in cash isn't just a month your snowball didn't grow, it's a month you actively kept it from starting its journey down the hill. Look, the goal here isn't to scare you or tell you to dump all your cash into the market tomorrow. The goal is to spark an aha moment. to help you see that the safe choice isn't really safe at all. So here's your first step. It's simple. Don't invest a dime yet. Just open a new tab and find an online inflation calculator. Type in the amount of cash you have sitting on the sidelines and see for yourself how much water your bucket is projected to leak over the next year alone. Understand the real cost of doing nothing. That's the first and most powerful step you can take. The biggest threat to your financial goals isn't some dramatic headline-grabbing market crash. It's the slow, silent leak in your bucket while you wait on the sidelines. It's keeping your snowball packed in your hands out of a misplaced sense of safety. Once you truly understand this, you can shift from being a passive worrier to an active builder of your own financial future.